Supply and demand zones are key levels where sharp price moves occur. Demand zones signal buying opportunities, as the price often reverses upward when it reaches the zone. Supply zones signal selling opportunities, as the price typically reverses downward when revisited. To identify high-quality zones, focus on these 4 key criteria. Strong candles. Clean, large candles leaving the zone signal strong institutional moves. Avoid zones with wicks or indecision. Freshness. Untapped zones hold more potential. Revisited zones lose their strength. Break of structure. Zones that break key support or resistance indicate institutional activity and new highs or lows. Imbalance. Price gaps highlight areas likely to be revisited, offering strong trade opportunities. Liquidity sweep. In a bullish liquidity sweep, the price dips below a significant low, triggering sell stops before reversing upward. In a bearish liquidity sweep, the price spikes above a significant high, triggering buy stops before reversing downward. The power of 3 strategy. The power of 3 breaks market behavior into 3 phases: accumulation, manipulation, and acceleration. In a downtrend, the process begins with accumulation, where the price consolidates in a tight range as smart money builds long positions discreetly. This is followed by manipulation, where a false breakout below the range traps retail traders in short positions, providing liquidity. Finally, the market moves into acceleration, where the price reverses sharply upward, starting a new trend or significant retracement. In an uptrend, it starts with distribution, as the price consolidates in a range while smart money quietly sells off their positions. Next is manipulation, with a false breakout above the range that traps retail traders in long positions. The final phase is acceleration, where the price reverses sharply downward, starting a new trend or a major pullback. Fair value gaps. A fair value gap forms when sharp price movement creates a gap between candles, acting as a magnet for price to retest before continuing the trend. Traders use these gaps as entry points for potential profits. To spot a fair value gap, follow these steps. Start by identifying 3 candles in sequence. Check if the high of the first candle and the low of the third candle do not overlap with the middle candle. If a gap exists between them, this is the fair value gap. Mark the gap with a rectangle to highlight potential bullish or bearish setups. For higher accuracy, combine fair value gaps with trend confirmation or market structure analysis to increase the reliability of your trades. Fibonacci retracement. Fibonacci retracements identify potential support and resistance levels during pullbacks. To use it, mark a swing low and swing high and apply the tool. Key levels like 38.2%, 50%, and 61.8% often act as turning points. For example, a pullback to the 61.8% level in an uptrend can signal a buy opportunity. Order blocks. Order blocks are precise zones where institutions place large buy or sell orders, driving strong price movements. To spot reliable order blocks, focus on these key characteristics. Liquidity sweep. Price must sweep liquidity above or below the previous candle. Imbalance. Price must create inefficiency or imbalance near the order block. Unmitigated zone. Valid only for the first price revisit. Mitigated blocks lose relevance, break of structure, or change of character. The order block must cause a structure break or trend reversal signal. These characteristics help identify high-quality order blocks for better trading decisions. Volume and time strategy. The volume and time strategy is a scalping technique specifically designed for the ZN market, which refers to the 10-year United States Treasury note futures. This market is a type of futures contract that is directly linked to the bond market. During the United States trading session, market activity significantly increases. Prior to the session opening, trading volume is usually low and price movements are subdued. However, when the market opens, there is often a sharp spike in both trading volume and price. This increase typically leads to the formation of a large candle, signaling the short-term direction of the market. Traders employing this strategy enter positions in the direction of the large candle formed at the opening. Their goal is to capture a small movement of 3 to 4 ticks, which can translate into significant profits for traders with large accounts, given the leverage in futures markets. Golden cross and death cross. Let's start with the death cross, a classic bearish signal used to identify the potential start of a downtrend. This occurs when the 50-day moving average crosses below the 200-day moving average, indicating that bearish momentum is building. Traders typically look for sell opportunities when this crossover happens, especially if it's confirmed by declining volume or weakening price momentum. On the other hand, the golden cross signals a bullish trend reversal. It happens when the 50-day moving average crosses above the 200-day moving average, suggesting the start of an uptrend. Traders often enter buy positions during this crossover, particularly when supported by increasing volume or other bullish indicators. These moving average crossovers are simple yet effective tools for spotting long-term market trends and aligning trades with the overall direction. The RSI divergence strategy. First, in a bullish divergence, the price forms lower lows, but the RSI forms higher lows. This indicates that bearish momentum is weakening and suggests a potential upward reversal. This setup often signals an opportunity to enter a long trade. Next, in a bearish divergence, the price forms higher highs, while the RSI forms lower highs. This divergence indicates that bullish momentum is fading and suggests a possible downward reversal, presenting an opportunity for a short trade. The pullback trading strategy. This strategy focuses on entering trades when the price retraces to key support or resistance levels, which often lead to price reversals. This approach provides high probability setups when combined with confirmation signals. In an uptrend, watch for pullbacks to support levels. Once the price reaches a support level, look for bullish confirmation signals, such as a pin bar or an engulfing candle. After confirmation, enter a buy trade and target the next resistance level as your profit zone. In a downtrend, monitor for pullbacks to resistance levels. When the price reaches a resistance level, confirm with bearish signals, such as a shooting star or a bearish engulfing candle. After confirmation, enter a sell trade and target the next support level for your profit. This strategy works best when combined with trend confirmation. Reversal patterns. Reversal patterns indicate a potential change in market direction and typically form at the end of trends. For bullish reversals, common patterns include the double bottom, the inverted head and shoulders, and the triple bottom, all of which signal a potential shift from a downtrend to an uptrend. For bearish reversals, key patterns are the double top, the head and shoulders, and the triple top, which suggest a likely change from an uptrend to a downtrend. These patterns provide valuable clues for traders to anticipate trend reversals and adjust their positions accordingly. Trend lines. Trend lines are an effective tool for analyzing market direction and spotting potential trade opportunities by visually mapping the market's overall trend. In an uptrend, draw a trend line by connecting higher lows. This line acts as dynamic support, where the price often bounces upward, signaling potential buying opportunities. In a downtrend, connect lower highs to form a trend line that acts as dynamic resistance, where the price tends to reverse downward, indicating potential selling opportunities. To trade effectively using trend lines, follow these steps. Accurately connect the relevant highs or lows based on the trend. Wait for the breakout. Observe for the price to break through the trend line, signaling a potential trend change. Check for confirmation, such as high volume indicating strong selling or buying pressure. For added confluence, use indicators like the MACD crossover to verify the trend direction. Once confirmation is established, enter in the direction of the breakout. Place the stop loss just beyond the trend line. Set your target at the next significant support or resistance level. Breakout strategy. A breakout occurs when the price makes a sudden, significant move in one direction, often following a period of consolidation. These breakouts can signal the start of a strong trend. For example, in a bearish breakout, the market consolidates within a range before sharply breaking to the downside, as shown by a large red candle. By checking the volume, you can confirm the breakout if selling pressure increases during the move. The same applies to a bullish breakout, where the price breaks upward from consolidation, confirmed by rising buying volume. Using factors like volume as confluence helps validate the strength of the breakout and improves trade accuracy. Candlestick patterns. Candlestick patterns help traders read market sentiment and predict reversals or trend continuations. Some important candlestick patterns include the hammer, which has a small body and a long lower wick, signaling a potential upward reversal. The bullish engulfing pattern shows a larger bullish candle completely engulfing the previous bearish candle, indicating strong buying momentum. On the bearish side, the shooting star, with a small body and long upper wick, often signals a potential downward reversal. Similarly, the bearish engulfing pattern features a bearish candle engulfing the prior bullish candle, reflecting strong selling pressure. The doji, a candle with little to no body, signals market indecision and can indicate a reversal or continuation depending on the context. Donchian channels. Donchian channels are a versatile tool for identifying trends, reversals, and trading opportunities. They consist of 3 bands. Upper band, the highest high of the selected period. Lower band, the lowest low of the selected period. Middle line, the average of the upper and lower bands. When the price repeatedly touches the upper band, it signals a strong uptrend. Look for long trades during these periods. When the price consistently touches the lower band, it indicates a strong downtrend. Look for short trades during these periods. Exit trades when the price breaks away from the bands, as this often signals a potential reversal. In sideways markets, the upper band acts as resistance, providing opportunities for short trades. The lower band acts as support, offering long trade setups. The last kiss strategy. This strategy focuses on breakouts and retests in a ranging market. After the price breaks out, it retests the level before continuing in the new direction. In a bearish setup, the price breaks below support, indicating a downtrend. It retests the support as resistance, and if it holds, it confirms the breakout, offering an opportunity to enter a short trade. In a bullish setup, the price breaks above resistance, signaling a potential uptrend. It then pulls back to retest the resistance, now acting as support. If the support holds, it confirms the breakout, providing a chance to enter a long trade. This strategy is effective because it ensures confirmation of the breakout before entering the trade, reducing risk and increasing the likelihood of success. Did I miss any of your favorite strategies, or is there one you'd like me to cover in a future video? Let me know in the comments section. If you found this video helpful, don't forget to like and subscribe. Your support means a lot. Thank you for watching, and I'll see you in the next video.